Welcome to the course, Basic Financial Analysis, Ratios, and Portfolio Monitoring in Microfinance Banks. What this course covers: financial statement and credit analysis, statement of financial position, balance sheet, income statement, profit and loss, cash flow statement, samples and exercise. The module will cover the following issues. Learning objectives. The objectives of the topics in this course are to understand the importance of accounting in microfinance. Operations. To acquire knowledge required for microfinance application. To understand and be able to prepare the financial records from the beginning. To understand the components of the various financial statements. Learning outcomes. Good financial analysis is the basis for sustainable and successful microfinance operations, not forgetting that information depends solely on the quality of data recorded for analysis. This course will help staff and managers of MFBs/MFIs understand and apply appropriate financial statements in order to ensure quality financial analysis and reports. Table of contents: 3 parts, 9 lectures, 2 assignments, 1 final quiz. Course outline breakdown: Part 1, which has Lecture 1, Lecture 2, Part 2, which has Lecture 3, Lecture 4, Lecture 5, Lecture 6, Part 3, which has Lecture 7, Lecture 8, Lecture 9. Now to critically look at the contents in what we will be studying. We have Part 1, which will cover understanding financial analysis and credit analysis. Lecture 1, which will cover what is financial analysis. Breakdown of financial analysis and credit analysis. What is credit analysis? Credit analysis process. Financial accounting overview. Understanding MFI financials, financial statements and operational reports. Then, Lecture 2 will cover credit analysis, capacity to pay, willingness to pay, investment plan, collateral, risks analysis, review question. Part 2 will cover understanding position, balance sheet, basic information needed for statement of financial position, balance sheet, analyzing statement of financial position, balance sheet, components of statement of financial position, balance sheet, types of statement of financial position, balance sheet, statement of financial position, balance sheet, items, sample statement of financial position, balance sheet. Lecture 4, Income Statement, Profit and Loss. What is the income statement, profit and loss? PL account items contained in the income statement, profit and loss. Items contained in the income statement, profit and loss, components of the income statement. Profit and loss, the income statement, profit and loss, breakdown, calculating sales in the income statement, profit and loss, calculating cost of goods sold in the income statement, profit and loss, calculating gross margin in the income statement, profit and loss, operational expenses, other income, disposable income, repayment capacity. Lecture 5, Ratio Analysis for Clients. Why do we need ratio analysis? Ratio Analysis Table, Sample Ratio Analysis Table. Lecture 6, Cash Flow Statement. What is cash flow statement? Cash flow statement components, importance of cash flow statement, cash flow template. Complete this exercise. Part 3 will cover understanding microfinance institutions' financial statements. Lecture 7, Financial Statement for MFI, Drafting Financial Statements, Statement of Financial Position, Balance Sheet, components of statement of financial position, balance sheet, assets, assets items, liability, liability items, equity, equity items, statement of financial position, balance sheet, template, sample statement of financial position, balance sheet, depreciation, depreciation sample. Lecture 8, MFI Income Statement, Profit and Loss, Income Statement Components, Income, Expenses, Income Statements, Profit and Loss, Items. Sample income statements, profit and loss, sample comparative income statements, comparative profit and loss. Lecture 9, Cash Flow Statement, Importance cash flow statement components, cash flow items, cash flow methods. Are you ready? Let's get started with the main course. Part 1, What is financial analysis? Financial analysis in 5 simple definitions. Financial analysis involves computation of analytical ratios derived from financial statements and the interpretation of these ratios to determine the basis for management decision. International best practice asserts that accurate financial analysis is the basis for maintaining a sustainable microfinance operations. Financial analysis is undertaken in order to determine if a project is a good investment for a proposed plan. Understanding the analysis would determine the liquidity, solvency, or profitability of the business. Dante and Muscula, 2013, page 10, says financial analysis is the process of identifying the financial strength and weaknesses of the firm by properly establishing relationship between items of financial statements. Analyzing the financial analysis of a business has a lot to do with examining the balance sheet, income statement, and cash flow and other applicable reports. Breakdown of financial analysis and credit assessment. Financial analysis. Financial analysis helps in evaluating economic trends and indices, used to set organizations' financial policy, shows how funds have been effectively invested in the business. It is used to build long-term plans. It is used to identify and compare. Projects through use of numbers and data. It explains the difference between the historical performance of a business. Credit assessment. Creditworthiness is considered as a criteria for granting loan to a customer. Conclusions are drawn from available data regarding the creditworthiness of the client. Assessment is concerned with the evaluation, identification, and mitigation of risks associated with loan granting. Clients are assessed based on information provided. Clients' repayment capacity is the subject matter of assessment. What is credit assessment? Credit assessment in 5 simple definitions. Credit assessment involves analyzing and determining the credit status of a client's loan request and making a concise decision based on his credit history and present assessment. Credit assessment result shows the ability of the client to repay the proposed loan or not. No loan should be granted until proper credit assessment has been carried out. In other words, credit assessment is the basis for granting loan. Lender institutions grant loans based on the confidence and creditworthiness of their client report. Creditworthiness encompasses the client's willingness and ability to meet his obligation to pay as when due. Quality credit assessment relies on information gotten from the client's cash flow statement, balance sheet, inventory turnover rate, general performance, and market conditions. In order to establish relevance for any credit assessment process, it is good for the client to have a viable business plan with good credit history. The client through his business should be able to show that it can meet up with the lender's repayment structure. Normally, credit analyst evaluating client business for credit approval usually likes to see up-to-date business records and good history of prompt payment before making decision about the loan. Credit assessment processes. This should include the following. Credit assessment processes should include the following: assessment of client's current and expected future income with correspondent disposable income, assessment of client's current and future expected debt obligation or debt structure if any, assessment of client's household spending pattern and payment behavior, assessment of client business position and that of the guarantor, assess credit history, red flags, overdraft or arrears, relationship with external customer, etc. Financial accounting overview. Microfinance institutions, MFIs, rely on good accounting information system as this is the cornerstone to continued existence of the institution. Financial reports do not only end when transactions are completed, it helps managers prepare budgets, determine future projections and analyze previous reports in order to make amends and also prepare for future outcomes. Every MFI manager must know how to interpret these sets of financial information which form the basis of the accounting system in which they work with. Microfinance professionals need to understand that accounting process entails recording of financial transactions, grouping them into various categories, and summarizing the results generated over a period. Understand MFI financials. In order to understand MFI financial statements, we need to understand the 3 broad areas to concentrate on. These areas are the financial statements, statement of financial position, the income and expense statement, cash flow statements, portfolio reports and operational reports, financial statements and operational reports. The usefulness of financial statements and operational reports enhances high performance and financial integrity for the MFI. The statements are assessed by a set of professionals and institutions which have various interests in the operation of the MFIs. The users of this information includes but limited to the regulatory authorities, Board of Directors, MFI staff, donors, investors, rating companies. We have come to the end of Lecture 1. See you in the next lesson.
Welcome to the Part 1, Lecture 2 of this topic. Let's dive straight into today's lecture. We would be looking at credit analysis is and how important it is in microfinancing. Credit analysis is the method in which MFBs calculates their prospective client's business creditworthiness and the ability of the customer to honor her financial obligations. When conducting credit analysis, it is important to analyze certain conditions that may determine the future of a loan with present or prospective clients. The analysis to look out for should include these 5 basic themes. 1. Capacity to pay. This bothers on the customer's ability to meet up with repayments as at when due. The issue that arises for capacity is the problem of not wanting to pay, and not the substance to pay from, even when he has stock in his business. Understanding client's capacity to pay will focus on the position of his profit and loss statement, availability and tangibility of stock and assets, business/household priorities, seasonality of income, diversion of funds for other business prospect. 2. Willingness to pay, the will to meet up with payment obligations even when the client has inadequate means to do so. Character can cloud a customer's decision to pay her loan obligation promptly. Factors that influence customer characters include difficulty in understanding client interior motives, recent family situation affecting the business, retaliatory reasons. 3. Investment plan. Investment plan should contain detailed explanation of proposed business undertakings. For microfinancing, investment should focus on the client's business and not ideas. MFBs should understand the clients as well as the business. Reason to grant loan for investment purpose should be tailored towards understanding purpose of the loan, i.e., purchase of asset, working capital, etc., expected income at the end of the project lifetime, cost benefit to both the client and the MFB. 4. Collateral. Focus on what can be used to recoup a bad loan should in case something goes wrong. Security for loan comes in various forms and should be well perfected before loan disbursement. Putting adequate measure to recover loan given out will involve having access to tangible materials owned by the client, accepting credible guarantors and exerting pressure for repayment, conducting appropriate perfection on accepted collateral. 5. Risks analysis. Every loan has a potential risk attached to it no matter how good the loan proposal looks. The best approach is to look for how best to mitigate such risk in event they occur. This also depends on your risk appetite based on the strength of your MFB. Risk events to watch out for include, identify the type of risk that can be managed so as not to severely affect the business. Measuring the level of risk appetite that both the client and the MFB can contain during decision making, prescribing risk mitigation measures and make sure it is being implemented by all parties. We have come to the end of Lecture 2, see you in Lesson 3. Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks, Part 2, Lecture 3 course. In this lecture, we will be talking about assessing your clients. The only way we can adequately assess clients is by going through their books of account. Note that even the most uneducated of your customers has a book of accounts they don't know about. A client's financial statement is quite easy to source and understand. All you need is a pen and paper, and your balance sheet, profit and loss, and your cash flow statement will be ready in no time. Remember, we are dealing with the client's financials only, no need for bulky assessment sheets. Just ask a few questions, and your books are ready. In this chapter, we will be looking at the balance sheet components only. We will be studying liability and equity in the next lectures. These 3 documents cannot work in isolation, so we'll need to study them in the next lectures. Now let's start with the balance sheet. What is a balance sheet? This shows the state of affairs of a client's business at a particular time. The snapshot at the time of assessment is what confirms the static nature of the analysis taken. What does a balance sheet do? It shows us where assets and liabilities are placed in the table. It shows us the source of the assets and liabilities. It shows us the worth of the business. It shows the liquidity position of the business, basic information needed for the balance sheet: cash, bank balances, debts from customers, prepayments to suppliers, stock/inventory, fixed assets, debts to suppliers, prepayments from customers, loans from other sources, formal and informal sectors. Once you have knowledge of all the above from your customer, you sure have a complete balance sheet you can work with to have a snapshot of your customer's business. Analyzing statement of financial position, balance sheet. Before analyzing the balance sheet, you need to understand how assets and liabilities work. Every asset focuses on the use of fund, while liability focuses on the source of fund. Let me break it down, but before this, I know you might be wondering why all this accounting scenario in microfinance application. The correlation is very important to understand the metric used to judge the performance of microfinance operations both from the customer's perspective and the business perspective. Assets, use of fund, comprises of money invested to acquire resources, can be on a short or long-term basis, must balance with liability. Liability, source of fund, funds provided by creditors for the business, can be on a short or long-term basis, must balance with asset. Now we analyze the statement of financial position, balance sheet. The balance sheet comprises of three important components, namely, asset, liability and equity. Let's discuss assets. These are tangible and intangible resources that the business own. They represent use of fund and investment for future generation of revenue for the business. Items in the business asset usually include but are not limited to cash, short or long-term investments, prepaid expenses, account receivables, fixed assets, vehicles, equipments and landed property. Liabilities, these are what the business owes to other parties or what has been incurred which must be paid in due course or in the near future. They represent source of fund for investment and must be accounted for. Liabilities are very important sources of funds for any growing business operations. It is a very efficient and effective way of generating revenue which can be assessed through borrowing from other financial institutions, funds raised through savings and fixed/term deposits or through donor activities from family members. Client liability items usually include but are not limited to partnership contribution, funds borrowed from other sources, account payables, other acceptable source of finance, equity. Equity is also recognized as net worth or capital. It shows what the business own and is made up of accumulated surplus/deficit from the client's business transaction. Activities in the equity determine the payment of dividends to shareholders of the business. Balance sheet items. Cash. Item under cash includes cash at hand as at time of assessment, cash in bank savings, current or other forms of legal account confirmed from the account statement by the business, accounts receivables. These are financial expectations from customers, whom the business has delivered goods on credit and is expecting payment, for goods or asset that have been paid for but has not yet been received. Stock/inventory, includes, finished goods and ready for sale at cost value, semi-finished products, raw material that is easily convertible finished products and not inclusive of old stock that has no value to the business, inclusive of client's own goods and not the ones he purchased on credit. Fixed assets, this is made up of, vehicles used for the business, plant and machinery, small and heavy equipments, land/premises owned. Accounts payable include, bills owed to supplier for material delivered to the client but has not yet been paid, advance payment made by customer and received by the client but the goods have not been delivered to the client's customer, running overdue expenses not yet paid, i.e. staff salaries, tax etc. Short-term debt, these comprises of, short-term debts or loans from different sources due not more than 12 months, payables due but not paid within 12 months, long-term debt, these comprises of, long-term debts or loan from different sources due but more than 12 months, funds sourced for financing long-term investment, could be formal or informal debt. Owner's equity, the owner's contribution to the business, determined once balance of liability is deducted from total asset. Types of balance sheet. The balance sheet can be constructed in two ways, position or types. They are either A. horizontal, B. vertical. Note, while they take different forms, the result is the same. Remember, basic accounting equation follows that, asset equals liabilities equity, or equity equals assets, liabilities or liabilities equals asset, equity. balance sheet workings. Let's take this sample question to give us a better understanding of the workings of a client's balance sheet. Questions. A prospective client wants to assess a $500,000 loan from your microfinance bank. In your assessment analysis of his business, you discovered that the client is currently owing another institution the sum of $40,000. The client has an inventory of $750,000 and is expecting receivables of $350,000. He currently has the sum of $35,000 with him, which includes his sales for the day, with a total of $74,500 in his bank account. His total business assets are worth $1,020,000. Construct a balance sheet for the customer. There you have it. All you just have to do is ask your customers these basic questions and your client balance sheet is ready for use. Note, the statement of financial position and the balance sheet are used interchangeable. Also, the focus of this lecture is for microfinance professionals and credit officers in particular to understand how to properly access a potential loan customer balance sheet. This concludes our lesion for Lecture 3. See you Lecture 4.
Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks. This is Part 2, Lecture 4 of the topic. In our last lecture, which is Lecture 3, we discussed the customer's balance sheet. Today, we are discussing the profit and loss account. At our next lecture, we will be looking at the cash flow. All this analysis still centers around the customer's account books and not the bank's book of account. The microfinance institution also maintains its own balance sheet, profit and loss and cash flow statements. We will discuss this in further lectures. Now, what is the income statement, also known as profit and loss? The profit and loss account shows the state of affairs of a business over a particular period. The analysis used is a representation of the record taken for assessment. What does an income statement do? It shows if a business is making a profit or a loss. It shows the position of the statement of the business. It reflects on the business, covering a particular period in time, i.e., daily, weekly, monthly, yearly. It helps clients understand the income and expenses they make and incur. The profit and loss components and breakdown include, but are not limited to, sales, costs of goods sold, gross profit, operational expenses, operational profit, family expenses, other incomes, monthly disposable funds. The profit and loss have three main components, namely, revenue, expenses, and the profit or loss. The revenue part takes cognizance of the total sales made for the day, where we deduct the cost of goods that has been sold, which gives up the gross profit. The next is the expense component, which sees us deducting all operational expenses from the gross profit to give us the operational profit. The last component is the profit or loss determinant. We do both addition and subtraction at this stage because we deduct all family expenses from the operational profit before adding other income to the operational profit to give us the monthly disposable income. Note that adding other income to your profit and loss statement must come with proof. Now let's talk about how to calculate sales in profit and loss. In order to achieve this, you must understand some basic principles. Understand sales and understand how it is being calculated when assessing your customer's profit and loss. What is sales? This is cash generated through quantity of goods or services sold or rendered to your various customers. This is denoted by this formula. Quantity sold, QS, multiplied by selling price, SP, which equals sales. How is sales calculated? Sale is computed with result gotten from records or declaration given by clients. Sales can be verified by cross-checking information from different sources. Sales record can be complex to ascertain because of its unreliability. Sales over a period vary from time to time. Some days might have good sales while some may have bad days. Verifying and cross-checking sales. Compare sales report gotten from different sources. Calculate sales based on client's record and declaration in terms of money or unit by daily, weekly, monthly, quarterly, biannually or annual sales. Cross-checking in sales. To confirm sales, you need to learn how to cross-check for accuracy. Let's take these scenarios as an instance. We all know 7 days makes a week. If we exclude Saturday and Sunday, it gives us 5 days. So let's use that as an example. Based on a 7 days a week analysis assuming 4 weeks makes a month, we have the analysis below. Client daily sales equals 10,000. Client's weekly sales equals 10,000 multiplied by 7 days equals 70,000. Client's monthly sales will then equal 70,000 multiplied by 4 weeks, which equals 280,000. The next thing we will be discussing is how to calculate the cost of goods sold. The cost of goods sold is the value of the purchased goods sold by the client to his or her customer during a specific period in time. It is very important you understand that cost of goods sold by the client is also the same as cost of goods purchased by customers. We denote cost of goods sold by the formula quantity sold, QS, multiplied by purchase. Let's look at the below example. A client purchased 1,000 pieces of bags for 10 each. He sold the 1,000 pieces for 15 each. What is the cost of goods sold? When calculating cost of goods sold, the purchase price of 10 is the determinant, not the sales price of 15. Remember, total sales 15 and cost of your purchase is 10, giving you a profit of 5. Note that calculating cost of goods can be way complicated when you have more than one product. At such point, we take cognizance of calculating the gross margin for the cost of goods sold. Calculating gross margin for multiple products when analyzing cost of goods sold, still using the diagram above, note that selling price equals 15 multiplied by 1,000 equals 15,000, purchase price equals 10 multiplied by 1,000 equals 10,000, profit equals 5,000, therefore, gross margin equals gross profit equals 5,000, which equals 33.3%. Using the below formula, selling price minus purchase price, divided by sales price, which equals 33.3%, as you can see, we arrived at the same figure. The above is for one type of product, hence we used the gross margin. If the product is more than one, then we use the weighted gross margin. Let's look at the example below and calculate the weighted gross margin. Study the diagram, cross-checking our result above using the formula we have. Gross margin equals gross profit divided by sales prices, which equals 4 bags 5,000 on profit divided by 15,000 selling price, making a total of 33.3%. For shoes we have 1,500, weighted gross margin equals 4 shoes, 1,500 on gross profit divided by 10,000 selling price, making a total of 15%. Having this information, we proceed to get our weighted gross margin. To get our weighted gross margin, we have share of sale in bags, which equals 15,000 divided by 25,000, representing a 60% plus share of sale in shoes, which equals 10,000 divided by 25,000, representing 40%. The final calculation for the weighted gross margins comes with adding our gross margin of bags multiplied by share in A, plus gross margin of shoes multiplied by share of B in sales. Adding all this figure together, we get a 26. Using the formula for cost of goods sold, we have sales multiplied by 1 minus gross margin in bracket for one products and sales multiplied by 1 minus weighted gross margin in bracket for more than one product. To conclude with calculating the cost of goods sold, we move to solve the above. Cost of goods sold, which is 25,000 multiplied by 1 minus 0.26 in bracket equals 18,500 naira only. The 18,500 naira only is the cost of goods sold for both products. Remember, if the product is one, we used the gross margin. If the product is more than one, then we use the weighted gross margin. Having understand how the cost of goods works, we move on to the operational expenses and the profit and loss. Let's look at the items in the operational expenses. But first, what are operational expenses? These costs are not directly related to sales or income but are fixed payment for specific purposes. They include but not limited to salaries, rent, utilities, transportation, communication, taxes, owner expenses, royalties, financial and other cost. Remember, in calculating operational profit we use gross profit minus operational cost, which equals operational profit. Now let's talk about other income and the profit and loss. How to calculate other income and expenses in the profit and loss account. First, we look at the other income. Other incomes are income derived from other sources that can be verified with proof by the microfinance institution before being added to the operational profit and other to show a relevant position of the client business in the profit and loss account. Family expenses. These are day-to-day family expenses incurred by the family but factored into the profit and loss account. Items include house rent, education fee, feeding expenses, clothing, transportation, health expenses, utilities and other expenses. Remember that for us to achieve this, we deduct family expenses and add other income. Disposable income in the profit and loss account shows the percentage of the customer's disposable income in the profit and loss account that is allowed by a particular financial institution for loan repayment installment. The percentage applied is known as a risk buffer, and it ranges from one financial institution to another and from particular percentage to another. 50% to 75%. The essence of this is to place the customer in the limits of his repayment capacity, as anything above the client's repayment will spell trouble for the MFB. To round up Lecture 4, let's take this example. A client requested for a $300,000 loan with repayment plan estimated at $60,000 monthly for 6 months. Using 50% as a risk buffer, he made a sale of $2,500. His gross profit is $2,125. The gross profit totals $375. Total operational expenses includes rent, $40,000, education, $23,000 only, clothing equals $5,000, transportation is $10,000. Health, $2,000 and utilities $7,000. He has a family expenses of $112,000. Using the formula below, 1. Find his disposal income. 2. Find the actual repayment capacity ratio. The repayment capacity of $60,000, which was initially given, divided by the disposable fund of $145 equals 41%. With the result above, the customer has the repayment capacity to access a $300,000 loan, since the risk buffer is 41%, which is way below the 50% benchmark. We have now come to the conclusion of Lecture 4. Note, the income statement and the profit and loss account are used interchangeable. Also, the focus of this lecture is for microfinance officers to understand how to properly access a potential loan customer's loan request. See you in Lecture 5. Take these review questions to better help you understand the profit and loss account.
Welcome to the Basic Financial Analysis, Ratios and Performance Monitoring in Microfinance Banks. This is Part 2, Lecture 5 of the topic. In our last lecture, which was Lecture 4, we discussed the customer's profit and loss statement. Today, we are discussing ratio analysis. This is a very important topic in this series of our lectures. Don't forget, we are still discussing this in the customer's account books and not of the banks. Customers have their own ratio analysis they are not aware of. They just don't know it because they don't know how important it is to their business, hence they don't use it. But for the microfinance institution, it is very important that they understand it to understand the metrics of their customer's business. Now, let us begin. Our topic for Lecture 5 is ratio analysis for clients. And now I ask, what is ratio analysis? But before then, we will be looking at ratio analysis under 5 subtopics listed below. 1. Ratio analysis for clients. Why do we need ratio analysis? How to generate ratios, sample exercise, and review question. Like I asked earlier on, I asked what ratio analysis is. Let us look at this step by step. First of all, what is ratio? A ratio measures the difference and relationship between values in other ways to make viable decisions. They are very significant for measuring a client's business performance over a period and is generated by dividing the numerator by a denominator with the result being expressed as a percentage. A monetary value, days or numbers. Why do we need ratio analysis? It helps us make viable decisions on loan approvals, it helps us understand the type of risk involved in the client business, it interprets client's business performance better, it proffers how best to mitigate risk that may arise during course of business, it clarifies the relationship between previous reports. The next thing we are going to be talking about is how to generate ratio. In order to adequately access a client's business to determine its net worth and take decision on loan granting, microfinance analyst is expected to understand the listed ratios below: liquidity ratio, turnover ratio, debt ratio, profitability ratio, and repayment capacity ratio. You don't expect a microfinance institution to have a repayment capacity ratio when he is not repaying a loan as a customer. This is the main reason why all these categories of ratio focuses on the customer's book. While understanding the above ratios, it is important to note that the results generated are a use or combinations of one or more book of financial statements, which are key elements in determining these results. To determining a client net worth and performance would require use of items in the client's balance sheet and the profit and loss only. Why do we need ratio analysis? While understanding ratios, it is important to note that results generated are as a result of the use of one or combinations of financial statements, which are key elements in determining results. Determining a client net worth and performance would require use of the client's balance sheet and the profit and loss ratio analysis table. This table shows how ratios are examined with a combined use of both the balance sheet and profit and loss statement to learn about its liquidity, operational efficiency, turnover period, repayment terms, and profitability. It uses a combination of metric to analyze a variety of financial data about a customer's book or company. To better understand the ratio analysis table, we will have to understand the contents therein. Starting from the types down to the formula, we will need to understand how they work to achieve the synchronization it desires. Highlighted in green, we start with the liquidity ratio. This is the value of current assets, divided by the value of current liability. These are both gotten from the balance sheet. The next is turnover ratio. This is the value of the cost of goods sold, gotten from the profit and loss, which is then divided by the value of the inventory gotten from the balance sheet. We go over to the turnover ratio days. This evaluates the value of the inventory in the balance sheet, multiplied by the numbers of days sales will likely occur, divided by the value of the cost of goods sold, gotten from the profit and loss account. Next is the turnover ratio days plus new debt. This shows the value of the inventory in the balance sheet plus the value of the new loan to be granted, multiplied by the numbers of days sale will likely occur, divided by the value of the cost of goods sold and gotten from profit and loss. We now move on to the debt ratio, where we analyze the value of debt to equity. This is the value of total liability divided by the value of equity. They are both extracted from the balance sheet. The debt ratio still has an arm where we determine an additional debt added to the current loan position. This is known as the future debt to equity ratio. This is the value of debt in addition to the proposed new loan gotten from the balance sheet, divided by equity gotten also from the balance sheet. Our next discussion is on profitability ratio. It shows the value of profit which is got from the profit and loss statement, multiplied by 100 and divided by the total sales that were gotten from the profit and loss. Finally, here, we look in the repayment ratio. This is the monthly repayment installment value divided from the total disposable income, both derived from the profit and loss statement. If you have been following this lecture, we studied both the balance sheet and the profit and loss in lecture 3 and 4 respectively. Below tables are answers gotten from the previous example we used, and we are continuing to use them here. So, if you want to understand how we got here, please refer to part 2, lecture 3 and 4 for more information. I have placed the link of these lectures in the description link below. Now, let's continue. Using below example as culled from our last lecture. It shows a customer who requests for loan of 300 with monthly repayment of 60,000 monthly for 6 months. The information on the balance sheet and the profit and loss has been used to populate the books of account. Using both customers' books of account, let's find the ratios of the current ratio, inventory turnover ratio, inventory turnover days with new loan request, debt to equity ratio, future debt to equity ratio, return on sale ratio, repayment capacity ratio, before taking on this exercise. Note that the statement of financial position with the balance sheet and the income statement with the profit and loss are used interchangeable. Also, the focus of this lecture is for microfinance professionals to understand how to properly analyze ratio analysis. This concludes our lecture for lecture 5. See you in lecture 6, as you can go ahead with finding the ratios in the exercise below.
Welcome to the Basic Financial Analysis, Ratios and Performance Monitoring in Microfinance Banks. This is Part 2, Lecture 6 of the topic.
In our last lecture, which was Lecture 5, we discussed ratio analysis. Today, we are discussing the cash flow statement. Cash flow in microfinancing is very important for any business to services. Remember, we are still discussing the customer's account books and not the bank's. Customers have their own cash flow statement difference from what the banks use. It is very important for microfinance institutions to understand the metrics of their customers' business. Let's begin. Our topic for Lecture 6 is Cash Flow Statement. Before we start, I recommend you subscribe to our channel at Microfinance Arena. We have some microfinance template we would be dropping in the description box below. These templates come very handy for microfinance professionals. We would be making these available in our subscribed member section. You can also request for templates used for microfinance operations as a subscribed member. And now I ask, what is the cash flow statement? A cash flow statement shows the amount of cash and cash flow equivalents that goes in and out of a client's business. This is one of the most important credit analyses that a microfinance institution must understand if loan is to be granted to the client. A well-structured cash flow will give a clear detail of the amount that comes into the client's business. Let's talk about the cash flow components. The cash flow components comprises of three major stages that makes up a client's cash flow statement. We have the inflow, the outflow and the net cash flow. First, we discuss about the inflow. This represent all incoming values which ultimately result in increase of liquidity for the client's business over the stated period. Items in the components included cash receipt from customer, loans, either formal or informal, income from other sources, cash receivables from customer, family member salaries. The next we will be looking at in the components is the outflow. This represent all outgoing values which ultimately result in decrease of liquidity for the client's business over the stated period. Items found in the components include monthly rent, monthly loan repayments, purchases, wages, salary, utility payments, monthly private facility expenses. The final on the list is the net cash flow. This is the amount of cash gained or lost by a business over a specific period. We calculate it by deducting total cash outflows from total cash inflows. Let's look at the cash flow items. These are items that are found in the client's cash flow. They are grouped into inflow and outflow items. Under the inflow items we have sales, loans, receivables. Under the outflow items we have salaries, loan repayment, utilities, rents and other expenses. In this course, it's not just enough to know the definition of a cash flow. It is good we know the importance of the cash flow statement. Most especially when it concerns customers we would be granting loan to. This would take us the importance of a positive cash flow. Your customers can have goods in their shops for sale. When they cannot easily convert them to cash, then it becomes a problem for the business. Let's look at what a positive cash flow can do. 1. There is increase in the liquidity of the client's business. 2. Debt settling is made easy. 3. Enhances reinvestment of funds. 4. Enhances return on investment to business owner. Imagine having to properly manage your resources all because you understand how a cash flow works. Before we round up, we would be looking at this sample customer's cash flow statement template. This template is very easy to use and well articulated for your customer's cash flow analysis. Remember to subscribe so you'll continue to get instant notification from Microfinance Arena. You can also drop your comments in the comments link below. Let's go back to our sample cash flow statement. A typical micro client's cash flow statement over a certain period takes the below form. This is a simple 6-month customer cash flow statement with a total column at the end. It highlights the inflow, outflow and net column. The column for the inflow section will be populated with all values that increases liquidity for the business. The column for the outflow section will be populated with all values that decreases liquidity for the business. The column for the net cash flow section will be populated with the remaining value after subtracting the outflow from the inflow. The extended table below the net cash flow we will be seeing in the sample exercise below shows the balances at the beginning and the end of each preceding months. For better understanding, let's take this sample exercise to better understand how our customer's cash flow works. A client record shows that she collected a loan of $300,000 in April 2018, with a loan repayment of $25,000 monthly. From January to June, she pays utility of $4,000 for her shop, $1,000 each as salary for her 5 staff and $5,000 for rent monthly. She was expecting $10,000 for goods supplied last year in 2017, which she eventually received in January 2018. From January to June, she made monthly sales of $20,000, $15,000, $25,000, $30,000, $33,000 and $40,000 respectively. She receives extra cash of $10,000 from her husband as support. While this concludes our lecture for Lecture 5. Compute the customer's cash flow below. Just follow the examples below and you'll understand where each item is placed.
Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks. This is Part 3, Lecture 7 of the topic. In our last lecture, Lecture 6, we discussed the customer's cash flow statement. Today, we are discussing another topic which focuses on the bank's book of accounts. On this topic, we would be looking at the bank's balance sheet. But before this, we need to look at the workability of the balance sheet and what it wants to achieve. In the list of orders, we look at 1. Format. Financial statement varies from one institution to the other. The differences are as a result difference in addition or subtraction of items, which are appropriate for each institution's record and analysis. 2. The application and functionality in this exercise is less important as the emphasis is more on understanding the various financial statements used in microfinance institutions and its adherence to international standard and practice. 3. Difference. Financial statements of different microfinance institutions of one country can be compared to the ones used locally, nationally, and internationally. The basic thing is to understand the accounting equation and arriving at a conclusion. Drafting financial statement. Financial statements are prepared by making use of information generated from the trial balance. They are prepared with reconciliatory measures to avoid mistakes and act as checks. When posting to the balance sheet, items posted are the final output that makes up the accounting system. Without the financial statements, it would be difficult and impossible to calculate performance ratios of microfinance institutions. The balance sheet for any financial institution is an integral part to managing assets and liabilities. Remember, we are now discussing the bank's books of account and not the customer's books of account. Customers have their own account difference from those of the banks. The balance sheet. This is now commonly called the statement of financial position. But for ease and clarity, we will be making use of the term balance sheet. In defining the balance sheet, we say, this is a stock statement that takes into consideration a snapshot of the microfinance bank's assets and liabilities at a particular point in time, with the date of transaction applied at the top of the balance sheet. Also, the balance sheet statement highlights what the microfinance bank owns and is being owed in terms of its assets and liabilities, and the differences show the net worth for a particular period. Finally, the balance sheet is compared in order to get a meaningful result on the growth of the microfinance institution and how well the resources are being managed. Note, the balance sheet must always balance. And this is because all debits must equal all credits, which are a basic accounting process in the balance sheet analysis. Components of the statement of financial position. Balance sheet. The statement of financial position has 3 major components, namely, assets, liability, equity. Assets. This represents what the microfinance institution owns or presently has. Most organizations seek funds externally or borrow money from other sources in order to build their asset base. These borrowed funds are invested into the MFI's activities. The International Financial Reporting Standard recommends that assets be recorded according to their uses. Let's look at the asset items. In the listed table below, numbering 1 to 10 in the asset column, we start with cash and cash due from banks, reserves at central bank, short-term investment, loan portfolio, and advances, loan loss reserve, other short-term assets, long-term investments, fixed assets, and depreciation. As seen in the total, only items 1 to 8 can be summed up. You can pause the video lecture to have a better read of the item descriptions. Liability. These are what the microfinance banks owe to other people or institutions. Microfinance banks incur liabilities that must be settled off at a specific date in the near future. Liabilities are a very good source of fund for the OPRAT of any financial institution because they are efficient and effective ways that revenue can be generated. Most of the money borrowed or generated from savings is given out as loans with normal or higher interest rates to deserving clients who are expected to pay back at specific dates. This source allows the institution to increase the liquidity status of the business. The liability items. In the listed table below, numbering 10 to 18 in the liability column, we start with savings accounts, voluntary or forced or fixed, deposits from other banks, loans, commercial bank or Apex, other short-term liabilities, tax payable, dividend payable, trade and other payables, and long-term liabilities, as seen in the total. Items 10 to 17 only can be summed up. You can pause the video lecture to have a better read of the item descriptions. Equity. Microfinance bank equity is also recognized as net worth or capital, and it shows what the microfinance bank owns or has. This is made up of accumulated surplus/deficit from the MFI's business transactions. Activities in the equity determine the payment of dividends to the shareholders of the business. Equities are not subject to repayment since such causes a reduction in the value of capital for the MFI. This is an advantage since the money can be reinvested or used to maintain operating expenses. Equity can come in two components, namely 1. Contributed or paid in capital. 2. Privately invested contributed capital. Let's take a look at the equity items. In the listed table below, numbers 19 to 24 are in the equity column. We start with shareholders' equity, donations, retained earnings, previous or current, and other capital accounts. As seen in the total, items 19 to 22 only can be summed up. And for the equity to balance, you will add the total liabilities and the equity to match up with the total assets. You can pause the video lecture to have a better read of the item descriptions. Please note that equity composition takes different forms and items for different institutions. And also, not all items listed above are usually presented in a statement of financial position. Let's take a look at this balance sheet template. Assuming we have populated figures in the template, we would see something that looks like this. Let us discuss the comparative balance sheet. When we need to compare balance sheet activities for different years, we have something like this. Looking at the balance sheet, we have the name of the microfinance institution with the title just above the table. This is to specify what periods own the record of the balance sheet. Another important detail on the comparative balance sheet is the dates on the values for the 2 years. The date is very important to know which year is being compared, while other asset items remain the same. The loan portfolio is being broken down into current, past due, and restricted. This is to identify the performance of the portfolio that the bank currently holds. A careful study is required to understand the information of the balance sheet. The assumption that this information is for accountants only is the main reason microfinance professionals and lending analysts have been novices in understanding the balance sheet and its comparative structure. We took the balance sheet analysis for December 2018 and compared it with that of 2017. Let us dive into depreciation. This is principally the wear and tear of an asset due to its usage, which causes such asset to lose its value over time. When an asset decreases due to usage, depreciation allows systematic allocation of value throughout its useful life. We require 3 main inputs to properly calculate depreciation. Useful life shows the time period in which the business considers the asset expendable. 2. Salvage value. After the useful life of the fixed asset, the company may consider selling it at a productive reduced amount. 3. The cost of the asset. The actual cost incurred in getting the asset, which includes taxes, shipping, setup, etc. We would be ending our lesson with depreciation types. We would be listing them in no particular order with advice to do a deeper study on them. 1. Straight line method or fixed installment. Reducing installment method. Annuity method. Sinking fund amortization. Insurance policy method. Revaluation method. Sum of the year's digits method. Double declining balance method. Depletion method. Final note. Items in the balance sheet are different for various microfinance banks, as source of funds and use of funds differs from each other. Hence, the need to make use of the present activities engaged in. This concludes our Lecture 7. See you in Lecture 8. And do remember to subscribe to receive notifications as soon as we release more lectures. Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks. This is Lesson 8 of the third part of the topic. If you have been following our lecture from Lecture 1 till now, you will understand how we got here and how all the lessons relate. Do take your time to go back to the lectures 1 to 7 for you to know the connection all the lessons have in common. Before we proceed, do well to subscribe to our channel. You have a lot to learn, especially if you're a microfinance professional willing to excel in your chosen career. Now today, we are discussing another important short topic which focuses on the bank's book of account. This is the profit and loss accounts. What is the bank's profit and loss account? The profit and loss account is a financial statement which sets out the results of the trading activities of an enterprise in a detailed breakdown of income generated and expenses incurred. Different businesses have different breakdowns of income and expenses and hence present financial information in the profit and loss account in different formats. However, the overall or net profit recorded in the profit and loss account for any business is also the amount by which the balance sheet value of the business has increased. What do the profit and loss account do? The income statement gives an overview of the financial activities of an MFI over a particular period in time. This statement covers a period of time and could be on a monthly, quarterly, or yearly basis with the aim of ascertaining the MFI's capacity to generate income for the business. As a performance indicator, the income statement is very useful to determine the future of an MFB. The total revenue generated for the business is summarized and deducted from total expenses for the period. Profit or surplus in an income statement is generated when revenue is in excess of expenditure, and a loss or deficit when expenditure is way above revenue. Income statements for MFIs differ from one another, with the changes in items placed in the column. Unlike the client's income statement, the information in the MFI statement is divided in a way that operating accounts are segregated from non-operating accounts. The income statement is divided into two components, namely, the income and the expenses. The profit or loss position arises when one of the items supersedes the other in terms of the budget. The analysis of both gives us the gross profit. Let's look at the income first. The income part of the income statement is a combination of several columns with data showing financial activities over a period of time. Microfinance institutions generate income from different activities. These could be through operating and non-operating activities. Incomes made from the operating account are those derived from the MFI's core financial service activities, while the non-operating incomes are those derived from external activities. Non-operating income includes sales of items like books, training, or external sources. The expenses part of the income statement is a combination of several columns with data showing financial activities comprising costs made over a period of time. MFIs incur expenses from different activities, and these are broken down into direct or indirect expenses. Direct expenses relate to direct expense activities, i.e., payment of salaries, while the indirect expenses, also known as overhead expenses, are expenses that keep the MFI running. The profit and loss items description. This table highlights the items and the corresponding descriptions relating to the profit and loss for an institution. We would be looking at two tables that would help us understand their roles, what they do, and their corresponding description. First, we look at the operating income. Under we have interest and fee income from loans. All revenue made from fees, commission, and interest on loans and other income relating to the loan and recognized on the gross loan portfolio. The next is income from investment. All revenue generated from the microfinance institution's assets other than the gross loan portfolio is usually in the form of interest-bearing deposits placed with other banks. The next is income from other finance-related services. All revenue generated from financial activities of the MFI other than the gross loan portfolio only, i.e., sales of forms on behalf of an institution. Lastly, we have the total operating income. This is the summation of all revenue generated on the gross loan portfolio and investment by the microfinance institution. We now move to the operating expense part of the profit and loss. Under we have the interest and fee expense, loan loss provisioning expense, staff/personnel expenses, general and administrative expenses, other administrative expenses, and finally total operating expenses. For the interest and fee expense, it comprises all fees and commissions incurred on deposits held by the MFB and deposited by the client. The loan loss provisioning expense shows an impairment loss expense. This is a non-cash expense calculated based on the percentage of the gross loan portfolio at risk, used in provisioning for loan loss in the balance sheet. Staff/personnel expenses. This comprises staff salaries and other financial benefits. It also includes payments such as benefits and bonuses made to employees of the MFI. General and administrative expenses. All expenses directed at the provision of services that keep the MFI functioning. These include, but are not limited to, rent, depreciation, utilities, transportation, etc. Other administrative expenses show all other administrative expenses directed at the provision of services that keep the MFI functioning. And finally, the total operating expenses. This shows the addition of all operating expenses made by the MFI. In our diagram above, where we mention the components of the balance sheet, we mention the gross income. The gross income has the items, namely, non-operating income/expenses. This represents the actual position of the transaction, which could either be positive or negative. Other non-operational income. These comprise all income that is not in any way related to the core operations of a microfinance bank. It includes gains made from sales of assets, property, or income from other investments. The total non-operational expenses. These are expenses that are not in any way related to core operations of a microfinance bank. Items include interest charged to other borrowing cost and depreciation. Finally, we look at the net income with represent if the business actually made a profit or loss. The total revenue is derived after all expenses has been deducted. The expenses including operational and non-operational expenses. Let's do some practical work here. Assuming we have an already filled profit and loss account for an institution, it would look just like this. The narration under the item column has a corresponding value on the right side. These figures are imputed based on the transaction that was carried out specifically for that purpose. You can take a pause to better study the table below. The items, operating income, and operating expenses in the table don't have value attached to them because they are the headings of the table. Final note, items in the balance sheet are different for various MFBs as the source of funds and use of funds differ from each other, hence the need to make use of the present activities engaged in. Before concluding this lecture, let us look at the other part of the profit and loss table, which is the comparative profit and loss statement. This is a sample comparative profit and loss statement. In this situation, we compare figures for 2 different years to better understand the performance of each and how best to manage the available resources allocated to it. Remember, financial institution profit and loss statements do not just end with the above analysis. Organizations use different formats in preparing their income statement. The most important thing is to arrive at a net result in accordance with the acceptable International Accounting Standard format. This concludes our Lecture 8. See you in Lecture 9, and do remember to subscribe to the other lectures in the description link. You also get to receive first-hand notification as soon as we release new learning content. Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks. This is Lesson 9 of the third and final part of this topic. Lessons 1 to 9 are readily available on the Microfinance Arena YouTube page. The lectures have been well prepared for easy access and understanding. Do take your time to go back to the lectures 1 to 8 in the description box below to know the connection between all the lessons. Before we proceed, we encourage you to subscribe to our channel. You have a lot to learn, especially if you're a microfinance professional willing to excel in your chosen career. On this final note, we will be discussing another important short topic which focuses on the bank's book of accounts. This is the statement of cash flow, or a cash flow statement. Now, what is a statement of cash flow? The statement of cash flow of an MFI shows the organization's liquidity assets and represents one of the key financial statements. Acting as a bridge between the statement of financial position and the income statement, it identifies the inflow and outflow of funds of an MFI and the application of fund usage over a period of time. It also analyzes how cash is generated and utilized over a particular period of time. Businesses usually come to extinction when there is no cash to run the business or when the MFI runs out of cash. Let us discuss the importance of the cash flow statement. Why is there a need for this? The cash flow statement is necessary in order to compare cash availability from operations to net income. When cash flow statements are compared, it helps active players like the board of directors, microfinance institutions management, owners, investors, regulators, and analysts measure how well the organization is performing operationally. The true picture of money received by the microfinance institution from its operations is clearly defined in a cash flow statement. In trying to understand the cash flow statement, we need to understand that it centers around 2 distinct processes, namely, cash flow statement, and 2, cash flow plan. We have already discussed the cash flow statement in length, so we'll be focusing on the cash flow plan. A cash flow plan predicts future inflows and outflows of cash timing for the microfinance bank. Projections can be prepared months in the future with the hope of avoiding a cash shortage. Effective cash flow plans are achieved if the microfinance bank business plan is detailed enough to understand how the inflow of funds and expenses are well appropriated. The cash flow components. These comprises of 3 parts, namely 1. Operating activities, 2. Investment activities, and 3. Financing activities. Cash flow component is based on past cash flow records or historical reports aimed at explaining how or where cash was generated from, how it was utilized, and the available balance of the MFI. Unlike a client's cash flow, which takes cognizance of income and expenditure only, an organization's cash flow classification is categorized into operating, investment, and financial activities. Looking at the operating activities first. These are income-earning activities for services provided by the microfinance institution. It comes in the first section of the statement of cash flows. It takes cognizance of operating activities by reconciling cash and non-cash items. The net result of operating activities is achieved by deducting receivables from net income. Investment activities comprises expenditures made for resources that would likely generate future income for the MFI and comes as the second section of the cash flow statement. In this activity, an MFI can generate income by selling off assets or equipment. Financing activities comprises funds or resources obtained or returned to investors either through short or long-term borrowing or through donor activities. This is the last section of the cash flow statement and shows an overview of how cash was used to finance the business. Let's talk about the cash flow summary. This has three main features which show that. This is the last part of the cash flow statement. It reconciles the summation of the operating, investing, and financing activities of the cash flow position. It ultimately connects to the balance sheet. The cash flow items. This shows the type of items you can find in the cash flow statement. Looking at the operating activities first, we have items that include accounts payable, depreciation, amortization, prepaid items. The next is in the investing activities. These include cash spent on property, plant and equipment, other physical assets. The final item on the list is what we find in the financing activities. They include share and dividend, proceeds from loans, cash flow methods. There are two ways to prepare a cash flow presentation. This can be prepared, namely, 1. The direct method. The direct method is presented as a cash flow, highlighting the transactions from sales to purchases and other expenses. We then have the second one, the indirect method. The indirect method is presented as a reconciliatory report from profit to cash flow. Showing us a sample of the direct and the indirect cash flow statement will surely give us a clue as to what we are talking about. First, let's look at the direct method. See the sample. Remember, as explained, that it is presented as a cash flow highlighting the transaction from sales to purchases and other expenses. You can pause to have a better understanding of the table. Then the sample for the indirect method. Also, remember that this method is presented as a reconciliatory report from profit to cash flow. On a final note, the indirect method is widely recognized and commonly used to present reports in financial institutions. Remember that each organization usually has its own items for its cash flow analysis. While the format is usually the same, the sample used is a guide to help you have an overview of what to watch out for when analyzing an MFI cash flow. This concludes our final Lecture 9 and the parts. Do take your time to go through all the other lectures we have posted. You can find them in the description box below. Do remember to subscribe to Microfinance Arena for more enriching and engaging content.